So there are things that could be keeping you away from being money savvy. So today I'll give you an 8-point guide to mistakes that people often make in their money life. My name is Wahome Ngari. I work at the Personal Finance Academy, and at the Academy we do very easy work. We just enable people to have a good relationship with their money. And let's get going. Number one, not having a plan for your finances. As individuals, we want to have financial goals in life and a plan of how to achieve them using the only money we earn or the money we have, not what we earn to have. A plan is just saying to yourself, when I get the money, I need to direct it where to go. Because if you don't direct money where to go, money will anyway go. Money loves moving. So if you don't direct it where to go, you put in money in your wallet, you didn't direct it where to go. When you see a nice shoe on the road, you buy it. So there's only one way to live debt-free and to translate into a stress-free life is to have a plan. And so a plan will always help you know how much to spend, how much to save, where to save it, and that kind of thing. And so if you want to have a plan, we need first to analyze our financial position. Then we set goals according to the cash flow, the money we have. So we need to have a good record of all our incomes. We need to know what incomes am I making? What liabilities do I have? What assets are in my name? So that then I can say, what do I want to achieve in the medium term? The short term, what do I want to achieve in the medium term, next 3-4 years? What do I want to achieve in the long term? So that I'm able to identify the vehicles I'm going to use for savings and for investing. No matter how little I'm going to do that. Some money can go into the chama, maybe some go to the SACCO, some to an insurance policy, a pension fund, a money market fund, a government bond, or some can go to plot. But most importantly, we must have a regular review of our progress, at least annually. And we have the old maxims I'm saying, if you fail to plan, you're planning to fail. When you have a plan, you have focus. You can actually be able to go where you want to go quickly. If you can't make one for yourself, look for help. And there are many people who can help you. Mistake number 2 is focusing on lifestyle instead of focusing on financial security. Financial security equates to ownership of, it's equivalent to having investments. Investments that generate some income. Lifestyle include just buying things like clothes for show off or going with the current fashion rather than investing. All those things we do, and they cost us a lot of money, but it doesn't take us far. And in the loss of income, whether it's a loss of job, whether it's a retrenchment, retirement, business failure, becomes very catastrophic. And that's why it is important to set up an emergency fund. But all said and done, we need to have income generating investments so that if our income is disrupted, we are able to go on. What we are saying, no matter how tight things are, even when we are very cash strapped, 10% of our income every month must go to investment. Can we have another mistake, very common? There's a lot of people who don't have a budget. Big businesses budget, So how can it be that an individual who hopes to make financial progress does not have a budget? The budget is the simple process of considering what monies do I have and deciding how best do I appropriate it, how best do I use it. Because failing to budget could lead to living from day to day without saving, or spending all your money and then ending up borrowing to continue spending. So we find we are living on the last paycheck, we are living on the next paycheck. If you want to be wise, you put in your budget. What is it you're planning to spend? This will put your money in order so that you do not have to spend what you don't have and you do not have to put things. It helps you not to overspend on something and not to underspend on something, not to forget the things that are important. When you work with a budget, you have clarity, you are efficient in the use of money. Mistake number 4, not having an emergency fund. We are always advised to hope for the best, but always plan for the unexpected. Always expect the unexpected. And a good example of this is a job loss. I don't know anybody who is insured against a job loss or business failure for the rest of their life. There's always something that's going to come up. And in this case, if anything happens, you want to have the money that will keep you in good state, that will keep you moving for the next 3 to 6 months. Some people call it a contingency fund, some people call it an opportunity fund. But this is a safety net which can sustain your livelihood if you lost your income or if you have an event of a financial emergency. Living without an emergency fund is like living on the edge of the cliff. Mistake number 5. Getting in trouble with loans. We see most people lose their hard-earned properties to loan recovery agencies, auctioneers, who auction them because they failed to recover the loans that were lent. So we must ask ourselves, why are people getting into all this trouble? How do we find ourselves there? If you borrow a loan, you need to service your loan promptly. And if you cannot service the loan, please don't take it. Let's not spend more than 35% of our income savings in debt. When we guarantee other people loans without regarding repercussions, that's going to be serious. So unless you are prepared to pay for it, don't become a loan guarantee. So borrow what you can afford to pay for a good purpose. And as we're taking loans, let's think about the cost of money before signing the paper. Because just saying yes to the loan without understanding the loan conditions is going to put us in a lot of trouble. And consider an expensive loans where the interest rate is not very high, like having a group of friends you can borrow from. It's called social capital. When I borrow from my friends, surprisingly, I pay zero interest because their business is not lending. If you face hard times and you're not able to pay the loan, don't disappear in the woods. Contact the person who gave you the loan. Go and negotiate. You might actually be given more time so that you're actually able to look for ways of paying it. And that's why we teach about debt management, so that people can be able to know, how do I engage in loans? Because eventually they say you'll only create wealth using other people's money. But to create that wealth using other people's money, you need to understand it very well. Mistake number 6, people not saving for retirement. And old age comes faster than we think. It is said that one should start saving for retirement immediately they get the first job, because by doing so, you're securing yourself financially in the future when you're at a much older age. In old age, you do not hope to depend on your children, you don't hope to depend on government, you don't hope to depend on society. They are not dependable. So it is safe to depend on your own income generating investments. And that is where we have the need to start investing for retirement when we get the first job at 24 years, if not earlier. We start early. Mistake number 7, and this is not having health insurance, what we call medical insurance. In most cases, people start seeking fundraising in order to seek medical help, and that is not a nice place to be. If you paid for health insurance, it becomes easy to ride, because when something happens, whoever is giving you health insurance is able to deal with that. And we are not immunized from bad health, and we are not immunized from accidents. When they happen, they cost money, and they don't cost little money, they cost a lot of money. We know they cost serious money. That's we need to have a shield. That shield is what is called medical insurance. At the very least, maybe we need to join NHIF. Before we call in people will always want to see we are doing something. It is important to say, do I have medical insurance? The number 8 is not having life insurance. In life, we all stand the dual risk of either living too long or dying too early. By living too long, we can exhaust all our finances, and that will become a liability to others. And that is why we need to have some retirement plan. Now, those who die young tend to leave their dependents in a financially disadvantaged place because they don't have somewhere to depend. And there's a product called life insurance, and life insurance provides the money cover for daily living expenses and pay outstanding debts that somebody might leave behind. Because a life insurance is an income replacer, the family left behind by the breadwinner needs to readjust their life, and they need some money for that purpose. And life insurance is immediate estate. When I say immediate estate is when death happens and we provide the money to the insurance companies, within a very short time, that money will be available for the family. But when you think about maybe money is seated in a bank, in other investments, it is a whole process for estate administration to get the letters of administration, which might take upwards of 3 years before the family is able to have that access to that money. Life insurance money is easily accessible. So take a moment of love and care. Think about the status of your dependents. If you took the final journey of no return, what would be their status? Where would you leave them? What would happen to the people who depend on me? And even accident insurance falls in that list. So we have seen a couple of mistakes. We have looked at the common ones that I had thought about. I know there are obviously others that I did not think about. There are always new ones that are evolving. These ones are also very common. Loaning or giving money to relatives and hoping they will pay you back. When you loan money to your relatives, please write it off. It will not come back. And if it comes back, it's going to mess your relationship. Once you've given it to them, it's gone. If you really think they need to borrow, show them the way to another nice place to borrow. Don't be the bank. Don't lend. You're not licensed to do that. If you do, and the money doesn't come back, be happy. Paying bills for others so that you look moneyed. Showing off. You're sitting with a group of friends and you're grabbing the bill all the time. That's a common mistake. Your friends actually get to know that. We should do something called going Dutch. Count how many are we, dividing the bill, everybody paying. Or everybody pays what they consume. Another common mistake is making big contributions when they put up a WhatsApp fundraising group. So you want to show off. That show off is expensive. Another common mistake is joining every chama you hear of. When you hear chama, munachanga ngapi 500, you join. Another ngiri moja, you join. And you have 10 of them. Let's say this. Chamas are not investment vehicles. That money in the chama does not benefit you financially. Chamas are social vehicles. All you get is social capital. So if you're looking to making money, chama is not the place to go and make money. The other common mistake is joining investments we don't understand. Oh, this is a common one. Kenyans get scammed because they join investments they have no idea. If you don't understand an investment, don't put your hand in it until you understand it. Another common mistake is not bothering about financial literacy. People are invited to a financial literacy program. I'm inviting people for free. You become indifferent. I say read a book, you become indifferent. Now, that's a big mistake. Your brain is just like a parachute. You need to open it for it to work. How do you open it? You must absorb ideas into it for it to work. Another common mistake is depending on the employer for everything. When you hard up, you go for a salary advance. When you have personal issues, you go for another loan. The employer is not permanency. The employer can go away, you can go away. Another common mistake is not writing a will even when you can see dangers of family conflict. And we have a lot of families in serious conflict because somebody did not decide what they wanted done. And the other a common mistake, very common mistake in Kenya, not informing your significant other of your investments or the bank accounts that you have. You know, nobody knows what you have. Nobody knows how much you earn. Nobody knows where the investments are. You understand the law in this country. If for 2 years the bank can't see you, the insurance company, the SACCO, everybody, they have to surrender that money to the Unclaimed Financial Assets Authority. And chances are it will get lost from the family. And I know as we have discussed these common mistakes, we have seen our own mistakes, not so that we beat ourselves, so that we do what is necessary to better ourselves so that we can improve. And that is why now I invite you to improve your money management skills so that you can get more value from what you're earning and you even avoid these common mistakes. So give yourself a chance for financial intelligence by sending a text to 0708 150 137. We have limited chances, so be the first one. If you think you're not able to do that, I can invite you to read a book. It's a nice book. I'm the author of the book. It's called Wallet Words. A lot of these mistakes are well addressed in that book and solutions provided. So again, 0708 150 137.